Right now, as you're watching this, something unprecedented is happening in financial markets. US stocks are falling, the dollar is falling, and Treasury bond prices are falling all at the same time. This almost never happens. And if you understand what I'm about to show you in the next few minutes, you'll see why this could be the single biggest threat to the Trump administration, your investments, and possibly the entire American economic agenda for 2026. Stay with me, because what's unfolding right now will directly impact your money. Let me paint you a picture of what just happened this week. On Monday, while Wall Street was closed for a holiday, European markets started declining. US stock futures dropped. The dollar weakened. Gold spiked. Nothing catastrophic, but the direction was clear. Investors were getting nervous. Then Tuesday came. American markets reopened. And that's when things got serious. Treasury yields, the interest rate the US government pays to borrow money, jumped sharply to their highest level in 4 months. Now, you might be thinking, so what? Interest rates go up and down all the time. But here's what makes this different. Stocks fell, the dollar fell, and treasury bonds fell, all on the same day. This is what financial analysts call a capital flight event. Money isn't just rotating from one asset to another. It's leaving US assets altogether. And the trigger? An escalating trade war between the United States and Europe that's threatening to spiral completely out of control. To understand why this matters, we need to go back to April of last year, what became known as Liberation Day. That's when President Trump launched his first major tariff sweep against multiple countries. Markets panicked initially. Treasury yields spiked. There was real financial turbulence. But then something interesting happened. The turbulence subsided quickly. European allies, unwilling to ruffle relations with the United States, came to the negotiating table. Deals were made. Trade talks began. The markets calmed down. Global investors learned a lesson from this. When Trump threatens tariffs, he's bluffing. He's looking for leverage. Eventually, everyone makes a deal, and things go back to normal. That assumption is now being shattered. Here's why. Trump's latest demands aren't just about trade anymore. Washington is now threatening tariffs over US demands to take over Greenland, a territory ruled by Denmark. We're no longer talking about trade imbalances or intellectual property theft. We're talking about territorial and military objectives. European leaders are finally realizing something critical. Capitulating on trade last year didn't appease Trump. It emboldened him. It showed him that the tariff weapon works, and he could use it for far more ambitious goals. According to Reuters reporting, French President Emmanuel Macron said in Davos that Washington's endless accumulation of new tariffs is fundamentally unacceptable. He's already called for the use of the European Union's anti-coercion instrument, a draconian tool for trade retaliation. His exact words, "We do prefer rule of law to brutality." This isn't diplomatic language. This is a line in the sand. Europe has now suspended the trade talks that underpinned last year's truce. They've retabled more than $100 billion in frozen counter-tariffs on US goods, ready to activate if Trump goes ahead with his latest tariff increase next month. The Europeans are not backing down this time. And that changes everything. Now, let's talk about why rising treasury yields are uniquely toxic for the Trump administration, especially in a midterm election year. When most people think about financial market reactions to political turmoil, they think about the stock market. The Dow drops 500 points, headlines scream about chaos, investors panic. But here's the reality. Stock markets are at record highs and are traditionally volatile anyway. Government officials can easily deflect stock market swings. They'll point to artificial intelligence hype, tech earnings, market bubbles. There are 1,000 explanations, and most of them have nothing to do with government policy. A declining dollar, that's actually not terrible for this administration either. In fact, a cheaper dollar helps US exports and aligns with Trump's stated goal of a global trade reset. Plus, it puts political pressure on the Federal Reserve to cut interest rates, which the administration wants. But rising treasury yields? That's a completely different animal. Let me explain why this is so dangerous. First, it makes US debt more expensive to finance. America is already carrying massive debt piles. When treasury yields rise, the government has to pay more interest on that debt. Every basis point increase costs taxpayers billions of dollars annually. Second, and this is the killer for Trump politically, rising treasury yields push up mortgage rates. As of Tuesday's market close, 30-year US Treasury yields are now 10 basis points higher than where they were at Trump's inauguration last year, despite the Federal Reserve cutting rates 3 times in the interim. Think about what that means. The Fed has tried to lower borrowing costs, But Trump's tariff policies are pushing yields back up, which feeds directly into mortgage rates. And Trump has made housing affordability a cornerstone of his economic agenda heading into the November midterm congressional elections. Rising mortgage rates torpedo that agenda completely. According to recent US opinion polls, voters already think Trump is spending too much time on world affairs and not enough on fixing the economy. Now imagine those same voters facing higher mortgage rates and potentially higher import prices from new tariffs. AXA Group chief economist Gil Moik put it bluntly, toying with more tariffs won't help. He notes that the 8 European states currently targeted account for 25% of US imports. A 10% tariff increase would lift the average US tariff rate by 2.5 percentage points, directly feeding into consumer prices. This is political poison in an election year. Now let's zoom out and look at the bigger structural problem that makes all of this even more dangerous. The United States currently has a net international investment gap of almost $28 trillion. Let me break that down. This measures the difference between what foreigners own in US assets versus what Americans own in foreign assets. Right now, foreigners own $28 trillion more in American stocks, bonds, and other investments than we own abroad. That's not necessarily bad by itself. It shows that the US has been an attractive destination for global capital. But it also creates a massive vulnerability. If foreign investors decide to pull money out of US assets, whether it's stocks, bonds, or dollars, that $28 trillion gap becomes a liability. We become dependent on the continued confidence of foreign investors. And here's where the European trade war gets really interesting. Europe holds gigantic amounts of US stocks and bonds. If this escalates into tit-for-tat retaliation, investment corps, or even financial embargoes, European governments and institutional investors might start reconsidering those holdings. The epicenter of the current conflict is Greenland, which is ruled by Denmark, a Nordic country. The Nordic region is home to some of the world's largest sovereign wealth funds. Norway alone has a $2 trillion sovereign fund, one of the biggest pools of investment capital on the planet. If Nordic funds or other major European institutional investors decided to reduce their treasury holdings even modestly, it would put enormous upward pressure on yields. The US government would have to offer higher interest rates to attract replacement buyers. Has any European divestment actually happened yet? We don't have concrete evidence of that, but the unusual pattern of stocks, bonds, and the dollar all falling together on Tuesday suggests that investors are at minimum pricing in the possibility. The market is starting to ask a question it hasn't seriously asked in decades. What if America's safe haven status is genuinely compromised? And treasury markets aren't just dealing with European concerns. There are major domestic issues creating additional pressure. Let me walk you through 3 of them. First, inflation fears from tariffs themselves. Debt markets are on edge about the long-term inflation impacts of ever higher tariffs. When you tax imports, those costs get passed to consumers. Higher consumer prices mean higher inflation. Higher inflation typically means higher interest rates. It's a direct transmission mechanism from trade policy to treasury yields. Second, the Federal Reserve independence question. Trump has repeatedly challenged Fed independence, suggesting he should have more say in interest rate policy. Bond markets hate this. Central bank independence is one of the key factors that keeps inflation expectations anchored. If investors start believing that the Fed will be pressured to keep rates artificially low for political reasons, they'll demand higher yields on long-term bonds to compensate for future inflation risk. Third, the Supreme Court ruling on emergency tariff powers. This is flying under the radar, but it's huge. The Supreme Court is expected to rule imminently on Trump's use of emergency powers to impose last year's tariff hikes. If the court strikes down those emergency powers, it could trigger a wave of rebates to companies that paid the tariffs. That would cut Treasury revenue significantly for a period, potentially forcing more government borrowing at exactly the wrong time, when yields are already rising. And here's an additional factor that hit markets on Tuesday. Japan called a snap election for next month. This catapulted Japanese long-term debt yields sharply higher on fears of a new mandate for big fiscal spending. Why does a Japanese election matter for US Treasuries? Because global bond markets are interconnected. When yields spike in one major economy, it ripples across sovereign bond markets worldwide. Japanese institutional investors are among the largest foreign holders of US Treasuries. If they need to bring money home to fund domestic spending, that's less capital available for US debt. All of these crosswinds are hitting simultaneously, So what are the actionable takeaways here? What should you actually do with this information? First, understand the risk to fixed income. If you hold long-term treasury bonds or bond funds, you need to recognize that rising yields mean falling bond prices. The longer the maturity, the more sensitive the price is to yield changes. This isn't a prediction, it's math. If you're heavily weighted in long-duration bonds, consider whether that exposure still makes sense in your portfolio. Second, watch mortgage rates like a hawk. If you're planning to buy a home or refinance in the coming months, understand that the window for lower rates may be closing. The Fed might want to cut rates, but if Treasury yields keep rising due to trade tensions and fiscal concerns, mortgage rates will follow Treasury yields, not the Fed funds rate. Third, pay attention to the dollar's direction. A weaker dollar affects everything from international purchasing power to commodity prices to the value of foreign investments in your portfolio. If the Sell America trade gains momentum, dollar weakness could accelerate. That has implications for how you think about currency exposure. Fourth, don't assume the pattern from last year will repeat. Many investors got comfortable with the idea that Trump's tariff threats are just negotiating tactics that always end in deals. The current situation with Europe, particularly over Greenland, suggests that assumption may no longer hold. The Europeans have drawn a line. Markets will have to price in the real possibility of sustained escalation. Fifth, consider the midterm election timeline. November's congressional elections are 9 months away. If Treasury yields keep rising and mortgage rates follow, the political pressure on the administration will intensify dramatically. That could force a policy shift, or it could lead to even more aggressive actions if Trump believes he needs to win the trade fight to save face politically. Sixth, think about safe haven alternatives. Notice that gold spiked when this latest round of tensions began. If confidence in traditional US safe haven assets is genuinely eroding, investors will look for alternatives. That could mean gold, certain foreign currencies, or even cryptocurrency for some investors. I'm not recommending any specific alternative, but understand why investors are thinking this way. Let me bring this all together. According to the Reuters report I've been referencing, there's a key observation at the end. Trump seems to feel confident he can ratchet up his domestic economic and geopolitical agendas tenfold this year. The precarious position of US debt markets may yet be one of the few things that could cool his engines. That's the central question right now. Will rising Treasury yields be the constraint that forces a change in approach? Last April, some analysts believe a Treasury yield spike after Liberation Day contributed to Trump backing down and making deals. Could it happen again? The stakes are higher now. The Europeans are less willing to capitulate. The debt burden is larger. The election timeline is tighter. The global financial system is more interconnected and potentially more fragile. The White House may be willing to shrug off stock market volatility. They may even welcome a weaker dollar, but a sustained surge in Treasury yields that pushes up mortgage rates heading into a midterm election, that's a different calculation entirely. This isn't about predicting exactly what will happen. It's about understanding the forces in motion and the constraints on decision makers. Keep watching Treasury yields. Keep watching European responses to tariff threats. Keep watching the political calendar. Because what happens in the bond market over the next few months won't just determine the direction of interest rates. It may determine the boundaries of American foreign policy, the outcome of congressional elections, and the stability of the entire global financial system. The information is all there. The question is whether investors, policymakers, and voters will recognize what's happening before it's too late. Thanks for watching. Stay informed, stay vigilant, and make sure you're positioned for whatever comes next.